Welcome to the deep dive. Our mission today, like always, is to sift through a pile of, well, pretty dense material investment reports, market research, company filings, and pull out the core insights you need.
Yeah, makes sense of the noise, basically.
Exactly. And today, we're looking at a real giant, a company that practically invented the modern energy drink scene. Monster Beverage Corporation.
Yeah.
Tickers MNST.
Oh, yeah, Monster. They're definitely the big dog in the yard. Ran the playbook perfectly for, what, 2 decades?
Right, but, and this is the crux of it, they seem to be at a major turning point. A strategic crossroads, you could say.
That's the core debate we found, threading through all these analyst notes. The big question is this. Monster built its empire on, let's call it, an extreme lifestyle brand. High energy, high caffeine. Can that identity, that powerful brand, actually pivot?
Pivot to meet this massive wave of consumer demand for health and wellness. Clean ingredients.
Yeah.
Functional benefits beyond just a jolt.
Exactly. And can they do that while still justifying the, frankly, premium price tag their stock commands? That's the tension.
It really is. Because, they trade like a growth company, but that growth path is suddenly facing some really agile competitors, nimble ones. It's forcing them into some defensive moves.
Okay, so let's lay out the starting blocks. Monster definitely has some serious strengths. The bull case is strong.
Absolutely. Where do we start? Market share.
Yeah, I gotta start there. They hold a dominant share in a global market that's still growing at a pretty impressive clip thing. High single digits year after year.
Right. This isn't like, soda, which is kind of flatlining in some places.
Right.
Energy drinks, functional beverages, demand keeps climbing.
It outpaces almost every other non-alcoholic drink category. It's a secular growth story.
And then there's the big one. Their ultimate weapon. Analysts call it the unmatched distribution moat.
That Coca-Cola partnership.
Yeah.
Sealed back in 2015. A 20-year deal. We'll dig into the details. But fundamentally, it gives them global reach that's just, wow, almost impossible for anyone else to replicate quickly.
It basically guarantees scale-up ability faster than anyone.
And don't forget their branding genius. They prove they can build these incredibly powerful lifestyle brands. Monster isn't just caffeine in a can. It's tied to extreme sports, music, a whole counterculture vibe.
Which gives them pricing power. And financially.
Pretty solid picture, historically speaking. Robust cash flow, usually high margins, strong balance sheet, the works.
Okay, so that's the fortress. Impressive. But every fortress potentially has, vulnerabilities, right? The bear case feels equally strong, maybe even more dynamic right now.
It does, and it circles back to that consumer shift, the number one threat. It's the competition from these better-for-you brands.
Like Celsius.
Celsius is the poster child, but also Alani Nu, others too. They're pulling in totally new customers, especially health-conscious women, a group Monster's traditional image didn't really speak to.
So the core customer base is actually changing, or at least expanding, and Monster's identity might be, too rigid, too locked into that original extreme niche.
Potentially, yeah. Then there's the growth puzzle. The U.S. market, their home base, is huge, but showing signs of maturing in some ways.
So they have to rely more on international growth.
Increasingly, yes. And while the Coke partnership helps immensely, going global is complex. It means lower margins initially, tricky logistics, dealing with currency swings.
Mm-hmm.
It's not easy money.
And internationally, you also bump into more regulatory headaches, right?
Oh, constantly. Concerns about caffeine levels, sugar, marketing to younger folks. It's a global minefield, and the rules are different everywhere. That adds cost and definitely limits some options.
Okay, one more bear point. Trying new things. Diversification. They dip their toes into alcohol.
Yeah, the Conarchy acquisition. And while the early results weren't great, they had some significant write-downs. It raises questions about whether they can execute well outside their energy drink wheelhouse.
So the core question remains, is that fortress, that moat, strong enough to handle this identity crisis and these operational challenges?
It's that classic innovator's dilemma, isn't it? Can the giant learn to dance nimbly in these new, smaller spaces?
Right. Let's define the playground first. To really get why Monster's valued the way it is, you need to grasp just how big this energy drink market is and where it's headed.
It's huge and still accelerating. Looking at the 2024 numbers from various reports, the global market size is estimated somewhere between, say, $79 billion and maybe up to $107 billion.
And critically, like you said, it's not slowing down. It's still got legs.
Definitely. The forecasts point to a HGR compound annual growth rate of somewhere between 7.7% and 8.5% over the next decade or so.
Wow, so what does that translate to in actual dollars?
Well, crunching those numbers, you're looking at a market potentially hitting $125 billion by 2030, maybe even soaring towards $220 billion, $223 billion by the early 2030s.
That's staggering growth. It's clearly not just a fad.
No, it's structural, driven by people wanting convenience, wanting drinks that do something for them, enhance performance, focus, whatever.
Geographically speaking, North America is still king.
Yeah, it dominates revenue. The U.S. market alone is pegged around $25 billion. It's the anchor.
But the growth engine, the future.
All eyes are on Asia Pacific. That's flagged as the fastest growing region. Rising incomes, urbanization. It's a massive pool of potential new consumers for these kinds of premium functional drinks.
So nailing Asia Pacific is pretty much make or break for Monster's long-term growth story.
Absolutely critical. Okay, so the market's huge and growing. Now let's talk about who's fighting for it. Because it used to be pretty simple, right?
Yeah, it was basically the Red Bull versus Monster show for years. Red Bull had, maybe 44% in the U.S.? Yeah. Monster around 33-34%. They set the pace.
That whole dynamic, it's fundamentally broken now. We're living in the era of the Celsius effect.
Right, the numbers there are just wild.
Aren't they? 2024 data showed Celsius sales in U.S. convenience stores shot up nearly 118% year over year. That's not just growth, that's taking share, aggressively.
And get this. Analysts estimate that Celsius alone drove somewhere between 30% and almost half, 47% of all the growth in the entire U.S. energy drink category last year.
Think about that. One brand, basically a newcomer compared to Monster and Red Bull, is responsible for almost half the industry's expansion. That tells you everything about the shift in what people want. It's undeniable.
And this rise came as others stumbled. Look at Bang Energy.
Right. Bang went all in on super high caffeine, kind of extreme formulas, and the market just turned away from that. Their volumes cratered down over 21% before they ended up in bankruptcy.
Which led to Monster stepping in.
Yep. Monster bought Bang's assets for about $362 million in 2023. Classic defensive move.
Yeah, it wasn't about buying innovation, was it? It was about taking a disruptive, low-price competitor off the board.
Exactly. And grabbing that crucial shelf space Bang occupied.
Right.
Prevent a rival from getting it. Pure consolidation to protect their core business.
But it's not just Celsius shaking things up. The market's splintering.
Totally. You've got players like Alani Nu posting insane growth, like 63%, really hitting that younger, social media savvy female demographic.
And Ghost Energy.
Ghost is up over 15%. Laser focused on fitness and the gaming community. It shows you can't just have one big energy drink anymore. You need products tailored to specific tribes, specific needs. The one-size-fits-all approach is dead.
And the driving force behind all this, the consumer's changed. It's not just about pulling an all-nighter anymore. It's about wellness.
Functional wellness, that's the key pivot. People want clean energy. They want function, not just pure stimulation.
So low sugar, no sugar, that's table stakes now.
Absolutely. Look at new product launches. 54% of them between 2022 and 2023 had sugar-free claims. It's expected.
And they're reading labels looking for natural stuff, green tea, ginseng.
Right. B vitamins, electrolytes. They want benefits beyond just energy. They want focus, maybe hydration, metabolism support. Energy drinks are basically competing with health supplements now.
And this ties right back to Monster's potential weakness, the changing face of the customer. Their core was always that young guy, 1834, action sports.
That group's still important, sure. But the growth, it's coming from elsewhere.
From women, primarily.
Largely, yeah. Celsius and Alani Nu figured out how to talk to female consumers, wellness messaging, fitness tie-ins, brighter packaging, fruitier flavors. It just resonated.
And that opened up not just a gender gap, but maybe an income bracket too, attracting higher income folks.
It seems like it. Monster's darker, more intense branding might even put some of those potential customers off. This new, broader demographic is the biggest growth pool, and Monster's arguably playing catch-up trying to appeal to them authentically.
Can't forget gamers either, that whole esports world.
Huge subculture. Driving demand for drinks that boost focus, reaction time, without the jitters or the crash later.
So the definition of energy drink has just exploded. From high stimulant, high sugar, to this complex functional wellness category. Monster needs to find its place in that new conversation.
Yeah, the Celsius effect basically proved there's a huge market hungry for health, transparency, function. Monster has to figure out how to bring its strengths, marketing, flavor, innovation to that party without looking like they don't belong.
Okay, so that's the battlefield. Intense competition, shifting demands. Let's flip it now and look at Monster's defenses. What are the moats? What justifies that stock price? Starting with their brand strategy.
Right. They don't just rely on the main Monster brand. They run a multi-brand portfolio, kind of like flanking maneuvers to cover different segments and protect the core. It's structured into 4 main reportable segments.
And the biggest chunk is still the core Monster stuff.
Oh, yeah, overwhelmingly. About 92% of their net sales comes from the Monster Energy Drinks segment. That includes the flagship original, but also really important lines like the sugar-free Ultra range.
Which is huge for them now.
Absolutely. Also Java Monster for coffee drinkers, Reign for the performance crowd, and now the Bang assets they bought lets them play in multiple lanes within energy.
Then there's the strategic brands.
Those are the ones they got from Coke in that 2015 deal, NOS, Full Throttle, Burn. Older brands, different price points, often strong in places like gas stations. Gives them breadth.
And the diversification attempt.
Yeah.
Alcohol brands.
Yeah, that's the Canarchy craft beer acquisition from 2022. Think Jai IPA, Dale's Pale Ale, plus their own flavored malt beverage, the Beast Unleashed, trying to find growth outside the energy space.
And this structure lets them, say, launch a wellness drink without messing with the main Monster brand's image.
Exactly. They can launch something like Rainstorm, their direct shot at Celsius, position it as total wellness, and keep the core Monster brand focused on its edgy, high-octane roots for the loyalists. Fight fire with fire using a different weapon.
Makes sense. But the ultimate weapon, the cornerstone defense everyone talks about, is still that Coca-Cola relationship.
Without a doubt, the TCCC partnership is Monster superpower. It's a barrier to entry that's just incredibly high.
How did that deal actually work back in 2015?
Well, strategically, Coke took a 16.7% stake in Monster. So Coke's incentivized for Monster to succeed. Their interests are aligned, financially speaking.
And they swapped brands.
Right. Monster got Coke's energy drinks like NS, Full Throttle. Coke took Monster's non-energy stuff like Hansen sodas. It let Monster focus 100% on energy.
But the killer part was the distribution.
That's the moat. TCCC became Monster's preferred global distributor. 20-year initial term. Think about it. Competitors have to build bottling plants, trucking networks, negotiate with retailers in every single country. Billions in costs.
Monster just plugs into Coke's existing system.
Pretty much. Overnight access to over 140 countries. They can focus purely on marketing, branding, flavors, the stuff they do best. Anyone wanting to challenge them globally has to somehow match that Coke pipeline. Good luck.
Okay, but is there a downside to being so reliant on Coke's system? You mentioned potential inertia.
Yeah, it's a fascinating strategic point. The Coke system is a marvel, but it's built for massive scale, moving huge volumes through traditional channels, supermarkets, convenience stores, vending machines.
Not necessarily the places where new health trends bubble up first.
Right.
Like gyms, health stores, online.
Exactly. Those niche channels are often where brands like Celsius get their start, building a following before hitting the mainstream. The Coke system might actually be too big, too cumbersome, to effectively seed brand new, niche products in those smaller, trend-setting venues.
So Monster might lag? They might have to wait until a trend is huge and then try to catch up or acquire the innovator.
It's a risk. The strength of that massive scale could paradoxically limit their agility at the very cutting edge of innovation. It could create a lag time.
And we saw some friction in that partnership before, didn't we, with Coca-Cola Energy?
We did. Back in 2018, Coke wanted to launch its own energy drinks. Monster objected, saying it violated their deal. It went to arbitration. Coke ultimately got the green light to launch globally, but the whole episode just highlighted that, while they're partners, their strategic interests aren't always perfectly aligned. They can diverge.
And this global distribution muscle is crucial because, as you said, the U.S. market is maturing. International is where the big growth has to come from.
Absolutely paramount. International sales are now around 40% of Monster's total business. That's a huge shift from just a few years ago.
Where's it working best?
Europe, Middle East, and Africa, EMEA has been on fire. Q2 2025, net sales up nearly 27% there. The TCCC pipeline is clearly effective in those regions.
But it's not easy, right? Lower margins, complexity.
Definitely trade-offs. Entering new markets costs money, building the brand takes time, margins are lower initially, plus you're dealing with all the local rules and currency fluctuations. But despite all that, that international growth potential is what's really propping up that premium stock valuation.
Okay, let's pivot back to the challenges.
Yeah.
The big operational one seems to be innovation.
Yeah.
Monster was brilliant at creating new flavors, dozens of them, but creating authentic wellness drinks, that's a different game.
Totally different. The market sniffs out inauthenticity fast. If Monster just slaps wellness on a can, consumers might see it as a cynical ploy from the original high-sugar brand.
So Rainstorm is their big bet here.
It seems to be their main direct response. They're calling it a total wellness energy drink, trying to hit all the right notes. 0 sugar, 0 calories, natural caffeine sources like green tea, functional extras.
Positioning it squarely against Celsius and Alani Nu.
Exactly. How well Rainstorm does is a huge test. Can Monster actually create a credible product in this space that resonates with that new consumer without alienating their core base? It's vital for defending U.S. market share.
Let's look at their other big strategic moves. M&A. Mixed results there.
Yeah, you could say that. The Bang Energy asset purchase? Smart, successful.
Because it was defensive consolidation.
Right.
Right in your wheelhouse.
Precisely. Removed price competitor, grabbed shelf space, textbook play within their core competence.
But the move into alcohol, it's a Canarchy craft beer.
They paid $330 million in 2022, and by 2024, they had to take a massive impairment charge, like $139 million on that segment. Huge write-down.
Ouch, what went wrong?
It just shows that being good at selling energy drinks globally doesn't automatically make you good at selling craft beer locally. Craft beer is a totally different market fragmented, localized distribution, different marketing. Monster's global machine wasn't necessarily the right fit.
Raises questions about their ability to manage a diverse portfolio beyond energy drinks.
It does. Okay, let's talk regulation. This feels like a constant headache for them.
And it's getting tighter, not looser.
Yeah.
And messy, because everyone has different rules.
Exactly. No global standard. China, a key growth market, has this really strict caffeine cap, 150 milligrams per liter. Many standard Monster drinks are way higher than that.
So they have to reformulate just for China.
Completely. New formulas, maybe different production lines, separate supply chains, huge compliance cost and complexity just for one major market.
Canada's strict too.
Yeah, caffeine per serving requires specific labels.
Yeah.
The EU mandates warning labels high caffeine content above 150 milligl. It makes launching one global product really difficult.
And age restrictions.
Becoming more common. Actual bans on sales to under 18s in places like Lithuania, Latvia, Poland. And even where it's not banned, many retailers in the US and UK voluntarily restrict sales to under 16s.
So the regulatory environment just keeps squeezing.
It's a persistent headwind, adds costs, limits marketing, forces constant vigilance, a material long-term risk.
One last strategic point.
Yeah.
Leadership. There's a change coming at the top.
Slight but notable. Rodney Sachs, co-founder and co-CEO for ages, is stepping down from the CEO role in mid-2025. Hilton Schlossberg, the other co-CEO, will become sole CEO. Sachs stays as chairman.
They've been a duo for decades, right? Built the company together.
Yeah. Any transition after such a long, successful partnership introduces some element of uncertainty, even if it's well-planned. Ensuring a smooth handover and maintaining that strategic focus, especially on international growth, will be key.
All right, let's get to the money. Despite all these challenges, why does Wall Street still give Monster that premium valuation? The financials must be strong.
Fundamentally, yes. Their financial resilience has been remarkable. Look at revenue. $4.2 billion in 2019, up to $7.1 billion in 2023. That's over 14% compounded growth annually. Fiscal 24 hit nearly $7.5 billion. Top line keeps growing.
But the margin story is maybe more telling. They got hit hard by inflation, like everyone.
Oh, yeah. Aluminum costs, shipping costs went through the roof post-pandemic. Their gross margin, which used to be up near 60%, dipped to just over 50% in 2022. That was a big squeeze.
But they bounced back.
Pretty impressively. This shows their brand power. They pushed through price increases, both in the U.S. and internationally, and customers largely paid them. Didn't see huge volume drops.
So they passed the costs on.
Mostly, yeah. By the end of fiscal 2024, gross margin was back up to 54%, operating margin around 26%. It shows the underlying profitability and resilience of the core business model.
And it throws off a lot of cash, right? Because they don't own the factories or trucks.
Exactly. Exactly. It's asset light. They outsource manufacturing and distribution, mostly to Coke. So free cash flow is strong, reported $1.67 billion in fiscal 24. CapEx is super low, like 13–14% of operating cash flow. The cash just piles up.
And that translates to good efficiency metrics, ROIC, ROE.
Stellar, really. Return on invested capital around 22%, return on equity around 21% in 2024, well above their cost of capital. It confirms they're creating real economic value, generating profitable growth, even with that small drag from the newer, lower margin alcohol segment.
So what do they do with all that cash? No dividends.
Correct. Long-standing policy. No dividends. They prefer to reinvest in the business and, importantly, return capital through share buybacks, aggressively.
Like that big Dutch auction tender offer.
Yeah, that was a major move in 2024. A $3 billion buyback using that specific mechanism signals huge confidence from management.
Can you quickly explain a Dutch auction for buybacks? How does that work?
Sure. Instead of just buying shares on the open market, the company sets a price range, say $50 to $55. Shareholders who want to sell tender their shares, saying the lowest price within that range they'll accept. The company then figures out the single lowest price, the clearing price, that lets them buy back the full $3 billion worth of shares they targeted.
So it can be more efficient than just buying randomly.
Potentially, yeah. It can allow them to get the shares they want, maybe at a slightly lower average cost. It's a strong signal.
And they actually borrowed money for that, took on some debt.
They did, about $750 million in new borrowings alongside their cash. A bit unusual for them, they usually have almost no debt. But leverage is still super low. Again, signals confidence in future cash flows to pay that back easily.
Okay, let's hit the valuation debate head on. That PE ratio, around 39–40x, that's way higher than Coke or Pepsi.
Definitely. Coke's maybe 23x, Pepsi 25x. Monster is absolutely priced as a growth stock, not a mature staple.
Why the premium then? What's the justification?
Two main things analysts point to. One, that continued double-digit international growth potential we talked about, that long runway. And two, the safety factor of that TCCC distribution mode. It insulates them from certain types of competition. They're priced for sustained high growth.
But they're not priced like Celsius, which has been trading at crazy multiples, sometimes over 100x PE.
Right. Monster's in this middle zone, valued higher than the old guard, but lower than the pure play, hyper-growth wellness disruptors, because Monster still has the legacy business and the complexity that comes with it.
So the valuation really hangs on them nailing those two things, international growth and successfully defending their turf with credible wellness products.
Pretty much. If they stumble on either of those fronts, you'd likely see that PE multiple compress, start looking more like a regular beverage company.
Got it. And quickly, there was some noise about accounting, a short seller report.
Yeah, after they changed auditors in 2023, there were some allegations in early 2025 about revenue recognition practices.
What happened?
Management pushed back hard, denied everything, said they follow GAAP rigorously, but the key takeaway, really, is that Monster's most valuable assets aren't even fully on the balance sheet at market value.
You mean the brand itself and the Coke deal?
Exactly. The brand equity, the distribution rights, those are incredibly valuable, intangible assets. Their true worth isn't captured by standard accounting, which is typical for strong brand companies.
Okay, let's synthesize all this. We've covered a lot of ground. What's the bottom line for someone trying to understand Monster right now?
Look, Monster is undeniably a top-tier company in its space. Super profitable, well-managed, with that incredible distribution advantage via Coke. The chance of this business completely collapsing, extremely low. It's a solid core operation.
But there's a big but. They're facing a fundamental challenge, not from another Red Bull, but from a shift in what consumers want. That core Monster identity, extreme, edgy, high stem, is clashing with this mainstream demand for wellness.
That's the existential rub. So their whole strategy now seems to boil down to a two-pronged attack. First, hammer that international expansion using the Coke network, get everywhere before competitors can build their own global systems.
And second,
figure out how to create authentic, believable wellness drinks like Rainstorm, maybe others that can compete head-on with Celsius without damaging the core Monster brand's appeal to its loyalists. It's a really tricky balancing act.
Which, interestingly, brings us right back to Coca-Cola, their biggest strength, their safety net. Could it also be their biggest long-term risk?
It's the provocative thought to leave people with. Monster depends utterly on TCCC for global scale. We saw that friction over Coca-Cola Energy. The contract is strong, sure, Coke will keep distributing.
But what if Coke's own strategic priorities shift even more towards energy and functional drinks in the future? Could they, subtly or not so subtly, prioritize their own internal brands within that massive distribution system?
Could they make it harder for Monster to quickly launch innovative new wellness products that might directly compete with something Coke is developing internally? It's not about Coke dropping them, but about potential strategic misalignment down the road.
So the very moat that protects them relies on a partner who is also, potentially, their biggest future competitor.
That's the tension, that reliance on a powerful minority shareholder whose own strategic interests might eventually diverge. That's arguably the single biggest long-term governance risk to monitor. The moat is deep, but the gatekeeper might eventually want the castle for itself. That potential friction is the key thing to watch.
A fascinating dynamic in a market changing at lightning speed. That's our deep dive for today. Thanks for joining us.
Yeah, great discussion. See you next time.